Picture yourself standing before an enormous haystack. Hidden within its depths lies a single, golden needle, your mission, to find it. Now imagine thousands of others, including experts armed with cutting-edge tools, all searching for that same elusive needle. This is the essence of picking individual stocks. For years, we've been told that smart investing means discovering the next big thing, the next Apple, the next Amazon, the next golden needle. This is the simplest path to sophisticated investing. Let's begin. But what if I told you that hunting for that needle is a fool's errand? What if the smartest move wasn't to search the haystack at all? What if the winning strategy was to simply buy the entire haystack? We'll delve into what an index fund is, why it consistently outperforms the vast majority of financial experts. They search the haystack and come up empty-handed more often than not. Information travels at lightning speed, and prices adjust almost instantaneously. The game seems rigged, but it's not. You just need to change the rules. Instead of trying to beat the market, you can choose to own the market. Second, there are fees. Actively managed funds charge high fees that eat away at returns. And we Lions conduct a head-to-head comparison of the two most popular index funds in the world, VU and VTI. This is the brilliantly simple, revolutionary concept behind the most powerful investing tool ever created for the average person, the index fund. Today, we're going to unveil this cheat code for building wealth. That difference, compounded over decades, can be worth hundreds of thousands of dollars in your pocket, not the fund managers. He posed a simple question: if it's so hard to beat the average, why not just buy the average? And because of the low fees, you are virtually guaranteed to beat the majority of professional investors over the long term. Let's compare the two most popular stock index fund ETFs in the world, both from Vanguard, VOO and VTI. As the name implies, its job is to track the S&P 500 index. These companies make up about 80% of the total US stock market's value. Its expense ratio is a razor-thin 0.03%. Its job is to track an index of the entire US stock market. It gives you exposure to the potential growth of the next generation of great companies, not just the current giants. It holds about 500 of the largest, most established large-cap companies in the US. Think Apple, Microsoft, Amazon, Nvidia. You win by not playing their game. Both are absolutely fantastic, world-class investments. VTI gives you slightly more diversification, which is theoretically better. VOO gives you a pure-play bet on the blue-chip champions of the economy. You cannot go wrong with either. The most important decision is simply to choose one and start investing consistently. In total, VTI holds nearly 4,000 different stocks. It is the entire US haystack. Its expense ratio is also just 0.03%. Question 1. Are index funds completely risk-free? No, it's crucial to understand this. You have the knowledge to build a portfolio that will beat the experts simply by owning the average at an incredibly low cost. It's the best way to help this video reach and empower more people just like you. Many experts recommend also owning an international index fund, like VXUS, to be truly globally diversified. Thank you for your time. Now go and build your future. You open a brokerage account with a firm like Fidelity or Schwab. You search for the ticker symbol VU or VTI and you place a buy order. It's that simple. A simple two-fund portfolio of VTI and VXUS gives you ownership in nearly every public company in the world. You don't need to find the needle, you just need to buy the haystack. An index fund owns stocks, and stocks are volatile. If the entire stock market goes down, your index fund will go down with it. Their safety comes from diversification, not from an immunity to market downturns. They are still a long-term investment. If you examine a chart comparing the two over the last decade, you'll notice something shocking. Their performance is virtually identical. They move in almost perfect lockstep. Its sole purpose is to mindlessly track the performance of the index. It doesn't try to be clever. It doesn't have a star manager making brilliant picks. It just buys the haystack. Because the fund is run by a computer that is just tracking a list, there's no need for teams of expensive analysts. This saving is passed on to you in the form of a tiny expense ratio. It's a list of stocks that represents a specific portion of the market. The most well-known index is the S&P 500. It is simply a list of the 500 largest publicly traded companies in the United States. This means the giant companies in the S&P 500 make up the vast majority of VTI's value as well. Those thousands of small companies have a very small impact on its day-to-day movement. The objective of a professional money manager, the so-called expert, is to beat the market average. By the time this video concludes, you'll understand why Warren Buffett, the legendary investor, has stated that for most people, the best approach is to invest in a low-cost index fund. First, you get instant diversification. By purchasing one share of an S&P 500 index fund, you instantly own a small piece of 500 different companies. Your risk is spread out. The failure of one company will have a negligible impact on your overall portfolio. And for the past 13 consecutive years, over 85% of large-cap fund managers have failed to outperform their benchmark, the S&P 500. Before we can grasp why index funds work so well, we need to understand why the alternative, picking individual stocks, so often fails. They dedicate their days to analyzing companies, poring over reports, and trying to uncover those golden needles. But the data on their success is absolutely brutal. Every year, S&P Dow Jones Indices releases a report called the SPIVA scorecard. It's essentially the official report card for professional investors. Let that sink in. Nearly 9 out of 10 professionals, whose entire job is to beat the market, fail to do so over the long run. Why is it so challenging? First, the market is incredibly efficient. So if the vast majority of experts can't beat the average, what chance does an ordinary person have? This brings us to the elegant solution pioneered by John Bogle, the founder of Vanguard. To understand this concept, we first need to know what an index is. An index is simply a list. An index fund, then, is a single investment vehicle, usually an ETF, that automatically buys all the stocks on that list. The benefits of this approach are profound. Second, and this is crucial, they are incredibly low cost. A typical actively managed fund might charge a 1% expense ratio. A good index fund might charge 0.03%. So by owning an index fund, you are guaranteed to match the market's return. Okay, you're convinced. You want to buy the haystack, but which one? First up, VOO. The official name is the Vanguard S&P 500 ETF. When you buy VOO, you are buying a concentrated bet on the titans of American industry. Now, let's look at VTI. The official name is the Vanguard Total Stock Market ETF. This means VTI holds not just the 500 large-cap stocks, but also thousands of mid-cap and small-cap companies as well. So what's the difference? The key distinction is that VTI includes those smaller companies. This makes VTI slightly more diversified than VOO. So which one is better? Let's look at performance. Why? Because even though VTI holds thousands more stocks, it is still market cap weighted. The verdict, honestly, for 99% of investors, the choice between VOO and VTI is not a decision to lose sleep over. Let's clear up a few final questions. Question 2. What about international stocks? VOO and VTI are focused on the US market. Question 3. How do I actually buy them? You buy them just like a single stock. Uplifting, empowering music fades back. In today you learned that the secret to winning the game of investing is to stop playing it. You now understand the simple, powerful logic of index funds, and you know the difference between the two most popular options on the market. If this guide provided you with clarity and confidence, please hit that like button. And to continue your journey to becoming a sophisticated, confident investor, make sure you are subscribed to the channel because there is so much more to learn together. Finally, in the comments below, let me know which fund you're leaning towards VOO or VTI. Let's see which haystack our community prefers.